But anyway, thanks everybody for showing up. Really quickly, to introduce our guest, I love to say this, but I think that the thing that we've talked about most, we've probably spent 2.5 hours talking in the last couple of weeks, but we ended up talking Marine Corps stuff more than anything else because he's a Marine veteran, but he's got an absolutely fascinating story. He's been involved in several different industries, and connected with him through a LinkedIn post. LinkedIn works. I put a post on LinkedIn and I just said something like, "Hey, the Biden had released details on what his new tax plan was going to look like. The 1031 was, is potentially, maybe possibly going away or whatever. And, I wanted to know who had POCs who could educate me on what that means, and led to a call with Kevin. I need to look up Kevin. I need to look up who tagged you in that post and tell them thanks. But
me, that was me.
That was you, David. Thank you very much. Thank you very much. But so with that, that's what got me thinking on, hey, if the 1031 goes away, there's a lot of people who are going to be affected, and I know there's other options to defer taxes. I think when you get to a point, and I know Ed's a proponent of this. I've heard him say this a couple of times. $1 saved is $1 earned. You can save, if you save $5 on taxes, it's just like making $5. So, so my mind started spinning a lot on, what other tax advantage strategies are there out there for people who are selling large properties and want to not pay taxes on all those capital gains. So tonight we are going to talk about exactly that, one tried and true method that's been around for a very long time. So that said, welcome Kevinbrenner, and, thank you for spending time with us tonight.
Unmute myself there. Thank you for having me. I was an entrepreneur before I joined the Marine Corps, so I've always been an entrepreneur. Even when I worked in corporate America, I was an entrepreneur. That's why they would assign me to go clean up defense contracts, things like that, because I would get in there and clean things up and make them profitable. I sold my first business my senior year in high school before I left from the Marine Corps for more money than most school teachers made in a year. So I started mowing lawns, hired kids to mow lawns, hired adults to mow lawns, and got contracts, and I was in the Chamber of Commerce when I was 16. So doing payroll, I used to ditch school to do payroll on Fridays. So I've always been that person. After the Marine Corps, I was only in 7 years, and I was still an entrepreneur. Even when I worked for another company, I always had a side gig going. Ended up a defense contractor. A former commander of mine asked me to come join him at ITT Industries. Then they wanted me to go back to Kuwait again. I thought, I'm sick of the sandbox. I'm not going back. So my financial advisor had been bugging me to become one. And I didn't think I wanted to do that. And he knew me better than I knew myself. He really did. He'd been my grandfather's advisor, my dad's advisor, my advisor. So I bought his practice, and I've never looked back. I've still bought other businesses on the side, but you'll notice I don't sound like a regular financial advisor. You want to talk funds and bonds and laddered scenarios and SPACs and ETF portfolios. I mean, I can talk that stuff all day long. It's about the taxes, though. That's really what gets you ahead. Managing expenses. Taxes are just an expense. We like to complain about them. We like to say all the things about them. We complain how the government spends the money, everything else. But taxes are just an expense, and you have to manage expenses if you're going to be profitable. So I hadn't been an advisor more than a couple of months, and one of my clients, who was also a longtime friend, said, "Hey, I've heard about this trust thing where I can sell off one of my properties. I don't have to do a 1031 exchange. I can't find the materials on it. Would you find this for me? Would you research it?" So this is in 2004, and I did. And I found it, and I got to working with an attorney that used to be at Ernst & Young. And that's how I learned about the entire program and started offering it to clients. The problem is, it's easy to get into investments. It's hard to get out of investments. All right? So getting in's easy, getting out's hard. How do you get out of something when it comes time to migrate? Now, a lot of people that are in real estate think, I'm never leaving real estate, I'm never selling, I'm holding everything forever. that might not be the best plan. There comes a point in time where exiting makes sense. But what do? You think you're going to do a 1031 into a DST or a REIT or something like that? How are you going to get out? And then you move into something that has higher expenses and less control than you had when you owned a rental property. Well, what happens when you pass away? What happens when you're 70 years old and don't want to be a landlord anymore? I mean, so there are alternatives to this. What if you want to buy apartment buildings and you want a clever way to get the owner to sell to you where he doesn't lose the income, he doesn't get taxed, he doesn't have to do a 1031, and now you can get better terms from him because he doesn't have to do all those things. You know that nice apartment building that looks like 1980, has an old landlord, it's in a nice neighborhood. He never raises the rent because he doesn't want anybody to move. He hasn't had a mortgage in 20 years, but he's never going to sell. And he's 86 years old. His kids want him to sell. His wife wants him to sell, and he ain't ever going to do it. I get him to sell to you under better terms. And I'll explain how we do that. All right. So managing expenses, managing taxes it's a big part of what I do in my practice. Do you want me to show the slides?
Yeah, let's do it.
Okay. All right. Let me see if I can. All right. Can you guys see that okay?
All right. I can see it. So I'm assuming everybody else can. Good.
Okay. All right. Tax for You is the marketing that we do. It's a website we have. And let me make sure my slides are going to work here. Forbes, I was featured in Forbes magazine twice. I had been an advisor for 6 months when I wrote a white paper on a more efficient way of generating income. In fact, having guaranteed income that was 50% better than what advisors tell you with the 4% rule. I pissed off my first broker dealer. I just resigned, started my own firm because I got tired of dealing with him. I was later featured in Forbes as a featured advisor in 2015. So I used to have a radio show, The Smart Money Hour, for 4.5 years, and I've been featured in Bloomberg Radio. There's a whole series of groups that I get featured in as well. This is just an illustration. Just because you haven't heard of something doesn't mean it's not legit, it's not real. You know, there's the things you know, there's the things you realize you don't know. Then there's all the things you don't even realize that you don't even know. And this is what gets people in trouble. So we'll talk to CPAs or attorneys and get their advice, and they don't know the first thing about this unless they worked at Ernst & Young. They really don't. So you can watch this video a little later. I won't take up time with it now, but if you go to taxfreeyou.com, you can watch the video. It's about a 2-minute video. I can give each one of you a free website to generate leads, to start going after old landlords. I can even teach you how to target old landlords, target properties, negotiate better terms to buy something that was never listed in the first place, and using the Installment Sales Trust to do it. We will help you do all of that. We won't charge you anything for it because we want the trust business. There's a second video on if you want to talk about a business, and that's at sellmybusinessnow.com. It's a little bit different, but this works for selling a business as well. All right. CB Administrative Services. That is the corporate trustee service that actually buys the property and then resells it in escrow. The trust only owns the property for a single day. And then we have trustees there that are trust administrators that manage the trust. But the trustee is actually a corporate trustee. The Installment Sale Trust was invented by Ernst & Young in the 1970s. They invented it to use internally for their own partners when their own partners wanted to sell back their partnership and exit the firm. They would get taxed on the whole thing. So they would transfer their membership in the corporation over to the trust. The trust would sell it back to the firm. The cash comes into the trust, and that defers all the taxes. It works on residential property, commercial property. It replaces a 1031. You can go from the trust back into real estate if you want to, but you get to buy at the next level up. You're not carrying over your lower basis. So it can even be a more efficient way to move between properties. That's a deeper discussion. But you can rescue a 1031. So if you know somebody's got an apartment building, their 1031's failing, we can save it and give you better terms to buy it yourself. It works for businesses and other highly appreciated assets. We're now doing a lot of Bitcoin. All right. And we're using an exchange in Zurich to do that. I have a relationship with an RIA firm in Zurich. My last name's Brunner. We have cousins in Bassersdorf, and that's how I met them. So the only things I've done actually, other than real estate or a business, I did a painting and the painting sold for $5 million, I would have thought the frame was worth more than the painting. I couldn't believe it sold for $5 million. Ugliest thing you ever saw. And then I did a coin and stamp collection where Grandpa had given the coin and stamp collection to his favorite grandson. Didn't tell anybody. It should have been part of the estate, or it should have been gift tax because it was worth over $20 million.
Whoa.
How do you unwind a mess like that? You can't go tell anybody how you got it. You can't declare it on the tax return. It's going to get taxed all at once. How do you unwind the mess that Grandpa created by doing this? He sold it to the trust in exchange for a note. The trust sold it at an auction in Manhattan, and over $18 million after commissions and transportation, all that kind of stuff, came back to the trust, and he gets income on $18 million forever. His grandkids will get income on that money. So it works for anything but publicly traded stock. I can't do publicly traded stock. The parties to the transactions, the seller, the trustee, and the buyer. You must have a trustee, and the trustee must be arm's length from the seller or the buyer on the other side, or the IRS will not allow the tax deferral.
So when you
That's
say
part
arm's,
of the Internal
length,
Revenue Code 453.
can you define arm's length? I mean, you just can't be involved, or what does that mean?
Father, mother, brother, sister, business partner.
Okay.
You know, it's got to be a straight up business transaction.
Got it.
Right. Here are all the parties to the transaction. I'll move pretty quick because you guys get it. Seller sells the asset to the trust in exchange for a note. And the note and the terms of the note are how you control the trust. But you do control the trust, you just control at arm's length. So the property's transferred in, the note comes back. The note has terms in there that you must dictate anything that's collateral for your note. You must be notified of all trades. All the accounts have dual signature securing your asset, because the assets of the trust are the collateral for your notes. You have every right to control those assets. Trust sells the asset to a willing buyer in exchange for the cash. So in escrow, in the case of real estate, the trust only owns the property for 1 day in the middle. Okay. Then it sells it to the final buyer, closes escrow, the cash comes in. The trust purchases specialty annuities. I know annuities are a bad word for a lot of people. There are special annuities that are used in endowments, they're used in trusts, and they're used by banks to invest in. These are not things that are available on the street, but that's what gives the account principal insurance. So the account's principally insured, the trust is, all right? One of the people I invited was trying to call in. I apologize. And then we also invest the money into an ETF portfolio that's managed by our in-house RIA firm. That's how we keep our fees down. The income from the investments comes back to the trust, and that's what generates the income for the note. The payments are taxed as ordinary income, but they're taxed over and above everything else. So all the basis and all the gains are all deferred. The money you would have lost to taxes, you're now earning a return on, growth on, compounded interest. So you're earning on all the income, not the after-tax income. So it just becomes interest income from the trust. We can show you how to manage that a little bit differently and even reinvest it in other projects. Upon receipt of the return of principal, the seller will be liable for the deferred gains. So the note is on 10-year intervals. So once you're in, it's for 10 years. At the end of 10 years, you can leave if you want, and that's when the gains tax are paid, or you can roll over for another 10. You can leave early. Every note has a callable feature. You want to leave, you can leave. Take your money and leave. That's fine. Okay.
But if you take your money, you obviously, that's when you pay your capital gains taxes on what's
that's when you pay the gain. So people say,
Yeah.
well, it's just deferring the tax. It's deferring the tax for as long as you want to defer the tax.
Yeah.
I mean, your grandchildren can be getting income on that money that hasn't been lost to the state and the feds.
But not only is it deferring the tax, but the money that you parked in there is also invested in other assets.
And it is growing.
Right.
All right. In fact, if you give me $1 million, we'll send you net of fees and expenses, $60,000 a year. And at the end of 10 years, we'll have $1.4 million or more in the account. I mean, it's sometimes the numbers are higher. It depends on the 10-year interval that we've tested it against. All right. I don't like to give the highest numbers. People start expecting that.
Yeah.
But it's $1.4 million or more at the end. So you can walk away or you can roll over for 10. Based on the tax law, the trust can only go 21 years. So we set it up on 10-year increments, and you can renew every 10. So you never run up against the 21. This shows a highly appreciated property. This was an actual transaction in Cupertino, California. The residence was worth 2.125. They originally paid 350. They did 75,000 of improvements. Their cost basis is now 425. The expense of the sale was 135,000 in commissions. The gain on the sale after expenses was $1,565,000. They get a Section 121 exemption because it was their primary residence. That's 250 plus 250. So even with that 500,000 exemption, which you wouldn't have like in an apartment building, right? Mm-hmm. This is still a better deal. Capital gains now is only $1,065,000, or the taxable portion of the gain. The gains taxes would have been $301,000 between, this was California, between Sacramento and Washington. Mm-hmm. They would have only had $763,000 left to invest. You follow the numbers down, it's 39.43% better than not using the trust.
So because you have the capital gains tax wrapped in, I mean, yes, because you're saving that $300,000 and you're able to invest that $300,000 into the annuities, the notes, and all the other products that you have.
Yes,
you're also earning money off of that $300,000, which gives you the delta of almost 40%.
Yes, and that $300,000 will double itself in 10 years or better. So pay the tax in, but you've still made the money on the tax.
Right.
And it continues to compound over time. Something else we will do for you. We have a lender that will lend money for 60 or 90 days at 4 points, and they get paid at close of escrow, so you can pull out your basis up front. In the case of this client, we could have helped them pull out their entire basis, the 350, the 75, and the 500 in advance, and only roll over the gain. You must take out your basis before escrow. So it's a short-term note. And then you can now invest that however you choose. So you're only investing the taxable portion. All right. So you can get your your basis out in advance. We'll even help you do that, which is kind of working against our own interest, because we want assets under management. We manage trusts, but we advise you that it might be in your best interest to pull out the basis first. And we have lenders that'll do a short-term note to do that, then they get paid off in escrow. You can't pull out basis in escrow because the IRS wants LIFO, last in, first out. Last in is the gain. So they're going to take anything that comes out in escrow as gain first before you get down to basis. We help you reverse that for a very low fee and get your basis out in advance and only roll over to the trust, the taxable portion.
And so yeah, the obvious advantage to that is when you get your basis out, it is tax-free. It is not income.
You can do whatever you want with it.
Yeah, it's part of the money that you put into the deal, part of the original equity you had in the deal prior to.
Most of the older clients give me that money to manage as well, because I'm a financial advisor. Sometimes they use that and go buy another property. All right, so they can do whatever they want with it. Something else that I have access to. I have a bank that likes to purchase insurance contracts because they hold it in their legal reserve portfolio. They will only do this on trusts. They will purchase an insurance contract on you. All you got to do is be able to fog a mirror. I don't care if you're unhealthy. I'm not kidding. They will buy a policy on the trust because they earn a rate of return on the cash in the policy. It's a permanent contract that never lapses. It's an investment grade insurance contract. They will buy one on every trust, twice the value of the trust. So when you pass away, your heirs get the death benefit on that, tax-free, and they inherit the trust as well. So you have that 80-year-old that doesn't want to sell because he wants his kids to inherit this. The kids don't want it. The Apartment Owners Association, in I think it was 2006, did a survey. And at that point in time, 1 in 5 properties made it to the second generation. They're sold because of health reasons of the owners. They're sold because dad died, mom doesn't want to manage it, or vice versa. They're sold because mom's managing it. Now she's in a home too, and the kids sell it to take care of mom. Or the kids sell it and divide the money. 1 in 5 makes it to the second generation. Everybody thinks they're going to be that 1 in 5. They're not. Been doing this a long time. I've watched a lot of transactions, thousands of transactions.
Our third, just for point of reference, our third transaction was a seller in that exact situation. He purchased the property, 20 years ago, and he was in his 70s when we purchased it, and his kids pressured him, his wife pressured him, and he finally gave in and sold the property. But I mean, that's exactly the situation he's talking about, and exactly how we picked up, a nice little 33 unit in Columbia. So
I have a husband and wife that won't speak to me. The husband wouldn't sell the property. Wife wanted to do it. Then they had a tenant that broke a pipe and flooded the downstairs with sewer water. And it was on the morning of the christening of their first grandchild at the church. He missed the christening of his first grandchild because he was at the building taking care of problems. When he got home, they were all home from church already. The wife said, "You have two choices, sell it or live in it. Call Kevin." She closed the door in his face. He had to stay at his son's house that night. He hates me. They make almost twice as much money from the trust every month than they ever made from the property. She loves me. The son loves me. Dad will not speak to me. When I see her twice a year because I manage their retirement account as well. He sits there with Fox News blaring so loud we can hardly hear anything. We have to go in the backyard and have our meeting. She loves me. The son loves me. He won't speak to me because I made them sell his property. He makes twice as much money from the trust they ever made from the property. Their son's going to inherit double the value. Son's happy about this. He's a doctor in Boston. He doesn't want to deal with his rental property in California. But the wife makes him travel to Paris and Rome, and he hates getting on airplanes, and he's so pissed that she makes him travel now. So he's afraid of heights. She made him go to the top of the Eiffel Tower. So he hates me. But it was a better deal for them. So real estate's an amazing investment because you get leveraged returns. But there comes a point in time that exiting is better. So when that property's been paid off for years, no mortgage, you've depreciated it down. Now you're paying more taxes on rental income than ever because you've lost all your depreciation. You need to do a couple of things. One, sell that and buy two, leverage up and get your cash on cash return up, or do an installment sale trust. But staying as they are is the least profitable, highest risk thing they can do. So I have two separate widows that are now clients, and we had to wait till the husband died. Then the minute he died, wife did it. All right. And so it's a better deal at some point. You guys that are looking for properties, you're still at a point that you're building your portfolios. I can help you get that landlord to exit without the 1031, without all those other things. You can go pick up that property. I'll even show you how to run a list, how to market the list, and get people that never would have listed or sold otherwise to list and sell to you. That property that needs repair, because it's clean, it's neat, but it needs to be renovated and rented out at market rates, right? And new tenants in there because they've not raised it. Everybody knows of at least one building that has the old landlord that doesn't want anybody to move, never raises the rents. It looks like 1980, the old building, right? And you know what would happen if you bought that building, renovated the whole thing, and rented it out at market rates, you'd have a building with 30% equity. You could refinance at 70% at today's rate and get all your cash out of it. That's a 12 to 18 month model to turn over a building like that. We have a guy in LA that uses me to get these deals. He does 5 or 6 a year that way. So I can help you get the deal because I want the trust business. But we give them a reason to do it. Now, a word of warning, you're all going to hit Google and you're going to find a few of my competitors out there. One of them I used to use, but we had problems with their trustee. Our program is supported by Lathrop GPM. Our program is supported by Boston Private Bank, and we can use all of them in our marketing. And our program will always pass an IRS audit. We can prove it. Every other program out there will fail an IRS audit 3 separate ways. If a good auditor asked any one of 3 questions, any one of those, they would fail the audit. The reason is they structure their deal a little bit differently to the client because the advisors make more money that way. So we don't have all those conflicts of interest. We don't have relationships with financial advisors except those that are in-house. In other words, we don't partner with other financial advisors, period. They have to join the firm. They have to work under our low fee program. Our fee for managing these trusts is 1% or less. We only send quarterly payments to the client. There's a whole series of things we do to keep our fees less. We always thought, how can we charge less, but we make the same? How can we be more efficient in our business model? And that's a lot of the reasons why we do the things we do. And that's why it generates that much more income and less risk for the client. So all the accounts in the trust are dual signature. The client can file a UCC1 for security. The client can tell us whatever they want to make them feel secure, and we'll do it. They can't be the trustee because that violates the rules.
What's a UCC1 filing? Is that?
That secures all the assets to the Secretary of State.
Okay.
And it's a public filing. A lot of people don't want to do it because it becomes public that you have an interest in this trust.
Mm-hmm.
All the accounts have dual signature. We can't take the money out. All the accounts have dual sign-in. So again, we'll do anything the client wants to make them feel secure, that nobody's going to Bernie Madoff their money.
Mm-hmm.
We don't have access to it, the way things are set up, all right? The administrator, which is a trustee administrator, CB Administrative Services. And then the trust administrator is Morris Chubb. All legal goes through Lathrop GPM. They're a top 50 national law firm for tax and trust law. Trustee Service Bank is Boston Private Bank. Qualified Financial, my firm, is the investment advisors that manage the assets. This is Section 453 of the Internal Revenue Code. If you read that tax code and think you're complying with it, you're not. There are 85 years worth of tax court rulings on how the courts and the IRS have interpreted the law in specific situations. Our secret sauce is we've read 85 years worth of tax court rulings. All right. So when we talk to the client's CPA or attorney, I promise you, there's only a handful of attorneys in the country that know more than we do about this. Right. So that's how we know not to do all these little things. There's a series of, it's not so much complying with the law, it's knowing all the little things not to do that will get the transaction unwound and the client taxed. And again, we're the only firm out there that doesn't violate any one of those things. So Morris Chubb is the trust administrator. Phil Johnson at Lathrop GPM is one of the attorneys that has been assigned to us, and that's myself. So what questions do you have?
So Mauricio had one, and I think it's a great question. You talked about marketing for deals. What size deals are you usually finding with this?
We target market for multi-units $1 million and above. Mm-hmm. Because believe it or not, it's actually easier to get the guy with a 20-unit building worth $1 million to do this than it is to get the guy with a duplex worth $250. Mm-hmm. I'm not kidding.
Is there a reason for that? Do you think it's because it's just a more sophisticated seller, or is there something else going on there?
Combination of things. When a person's got 250, it's only 250 they've got.
Yep.
Guy's got $1 million, usually has something else.
He's got more. Yeah.
Yeah. He should be working on that.
Actually, I find the same thing's true with a lot of the passive investors in the deals that we've done. You know, the people who are asking, can I go below the minimum investment, usually only have that amount of money. Yeah. And, you know, people who have a lot more, people who are saying, yeah, 75 or going above the minimum, you have a lot more to pull from. But, and then Mauricio, yeah, he says tax bill hurts a lot more at the $1 million level. And I'll tell you what, I mean, yeah. I've only sold 2 investment properties, but not planning for that capital gains tax bill, you know, and selling a property and realizing that you just had $150,000 in capital gains kind of sucks, you know. And
I get calls every year, 5 days for the close of escrow. Mm-hmm. The CPA just came back telling me what my actual tax bill is going to be. He forgot to account for depreciation. He forgot to add in the state tax. Yeah. Can I still do this? Can you get a delay in escrow? We can't do it in 5 days. Mm-hmm. No, you're stuck. I got no less than 6 phone calls in February and March of this year when they finally found out what the total actual tax bill was. Because here's the deal. Mm-hmm. You're going to be taxed on this transaction, but it's going to adjust your AGI and everything else. It's going to drag everything else you're making up into a higher tax bracket for that year. Yes. So it's not just the impact. Look at Mauricio nodding his head. He knows. It's not just the tax on the deal. It's the fact you're causing everything else you've earned that year to be in a higher tax bracket as well. The total impact is tremendous. And they call me panicked. Is there anything I can do? Can I do anything? No, you sold that building last September. You're stuck.
Yeah.
Your CPA gave you bad advice. Why don't we find out who his malpractice or E&O carrier is and file a claim?
Yeah.
so I've helped clients do that.
Let's set this backwards then. I mean, how long before a transaction do people need to talk to people like you?
Please give me 30 days because at least 30 days, because they're going to, here's what happens. We give them a bunch of information. We explain it to them. Then they talk to their brother-in-law, at the weekend barbecue over a beer, and the brother-in-law's, know it all. And then it scares the hell out of them, or they go talk to a CPA. 4 out of 5 CPAs, if it's not on the tax return, don't even talk to them. Just don't. And after 17 years now of doing this, I'm telling you, they're horrible. And just because they know nothing about it doesn't preclude them from having an opinion. So we run the numbers. We will develop a complete pro forma. I've come back and told clients, pay the tax and here's what we're going to do afterwards. Okay. So I've shown clients how to take other deductions. I've shown clients how to implement other types of tax planning. We don't always tell them to do this because this isn't all I do. So I do have other options, other arrows, in the quiver, right? So, but we run a full pro forma and we will teach the CPA. Christian Ramsey wrote a book on this. He is our RIA and our in-house, he manages all the deals in escrow for us as well. We have an 8-hour class where the CPA, attorney, financial advisor can get 8 hours continuing education credit for attending our class.
Nice.
So the CPA needs to attend our class before he's qualified to advise on this, or the attorney.
CPAs need the continuing education credit to keep their license too, right?
Yeah, they have to have 40 hours a year anyway.
Yeah.
So this is 8 extra hours we can give them just for, we'll give them all the material. If they can answer the questions, we'll give them a certificate that they've obviously read the material, right? We want to train the CPA because the CPA's got at least 5 other clients just like this one he wants to be a hero for. So we will spend the time to train the CPA. Just don't you explain anything other than the benefits. Let us get the trust and get you the listing and the sale or the property or what it is you like. Because if the transaction doesn't happen, then nobody's got a client, right? Nobody's got a building they've added to their portfolio. So I can show you guys how to go hunting for buildings that aren't even on the market. Now, here's the other thing. The trust can carry back 20% for 36 months.
So explain that in layman's terms. Can carry back 20%.
You buy $1 million building, you only have to come up with $800,000 between down payment and whatever loan you've got, and we'll carry back a silent second. You can keep some dry powder to do all the renovations, move those tenants out, remodel, fix that parking lot. In the case of California, do the seismic work they've not done so they don't lose their occupancy permit. You see? So but you have to pay us off in 36 months. The trust can carry back. So we can create better terms. So there's 2 parts of a deal, price and terms. Sometimes terms are worth more than price.
We've lost deals on terms. We've been highest bidder before, and you're absolutely right. I mean, we have lost bids on terms because the other buyers have done a little more homework, and it sucks, but they do a little more homework, figure out exactly what the seller wants, and they win.
I have bought and sold over 30 businesses personally. I never write a check. I always negotiate terms. They can have whatever price they want for the business. Terms. Eventually, they don't want to give me a term, then we got to start adjusting price. How you negotiate. Always negotiate terms. Tell them you're giving them full price. Let greed, they're getting their price, and they'll start giving you terms. Those terms are worth more than the price. And I bought a business brokerage with no money out of pocket. Sold it a year later for 40% more than I paid for it. Never wrote a check for anything. Took a salary for my wife and I out of the whole thing. Sold it back to the international franchisor. Look up linkbusiness.com. I owned the U.S. franchisor and the Los Angeles franchise.
Nice.
Because I bought it all on terms. And then I turned the company around, reorganized it. And then I knew the international franchisor was going to want to buy it back. It was all about terms.
Yeah. So back to what you just said about the terms. I mean, if you are on the buying end of this, so the seller puts it into the trust and then you buy it from the trust. If it's $1 million building, you guys will basically carry a 20% note, helping them with the down payment or renovations or whatever, which basically means that if you can do this through Kevin, I mean, what I'm seeing is you can start using other people's money a lot quicker and basically put a lot less capital into the deal and walk away with an asset.
Guy in Los Angeles, that's how we always do it.
Mm-hmm.
He renovates the buildings. He refinances at 70% loan to value at today's interest rates, refinances us off. And the longest it's taken him, I think, was 21 months on one building. And that was the city's fault. You can't get inspectors to show up to do anything.
Mm-hmm.
So, and then he refinances us off and the trust gets the money. And that way he keeps more dry powder. And he's got 30% or more equity every time he does a deal. Because once he has the new rent rolls and the new appraisals on the building and all the work he's done to it,
cash out.
What is it appraised for now versus what he has into it? He refinances everybody off.
Mm-hmm.
And now he's got a loan at 70% loan to value, 30% equity, and no money in the deal.
Mm-hmm.
And he uses us to get those deals.
Infinite return right there.
Yeah. Now he's really cranking up. He might actually knock out 12 deals this year, just himself.
Now I know
he's not a realtor.
I know you got to cut at the top of the hour, so just keep looking at time. We got probably about 8 to 10 minutes before you got to jump and run. But a couple of questions that got dropped in there, and one of them's I really like the question. It's about what do you have? What? I'll just read the question. Is there a presentation cost analysis you provide a reluctant seller to help show them? So if we want to take you up on your service to help find these properties, how do you convince sellers? What do you do there? How do you?
We actually have a report that shows keeping the property, what your income and appreciation is, and doing the installment sales trust, and it compares the two side by side. We have a second pro forma that is what if you sold with or without the IST.
Mm-hmm.
So between these reports that we do that are actually compiled by a CPA, they fill out just a one-page fact finder. They fill in the blanks.
Mm-hmm.
And every time we get to the other end of the deal, it turns out they fudge their numbers better.
Mm-hmm.
It's never as profitable as they say it is. How many times have you seen that, right?
Yeah, every time.
So, but we will do that part. We just need the introduction. And I'll call you back 30, 35 days later and say, okay, we've talked to their CPA, their attorney, they're ready to go.
Okay.
And we do that because if there's no transaction, I don't have a client either.
Okay.
So I will help you get those deals.
So
I'll even help you get a title list to target the properties that are likely those kind of properties.
So you're basically doing an individual, here is option A, here is option B, if you were to sell it right now, based on their property or based on their input on that one pager, not based on the property, right? Based on their input.
Yes.
Okay, got it.
And I'm very good as a financial advisor, making sure I'm not talking to one leg or just the husband. I want the wife involved because she sees more income and more safety and security. More money goes to the heirs from the trust than whatever go from the property.
Yeah.
Of course, you know, the minute we hang up, she's bending his ear, right?
Yeah.
She wants to make sure the kids get more and they don't have any more risk of owning a property, right?
Absolutely. Now
she doesn't want to have to manage that thing after he's gone.
Another question, this from Ed, who was our speaker last month, and his video's up on YouTube already, but we'll post this on YouTube too. But he says, can assets be commingled in the installment trust?
You mean sell a rental property and then something else as well?
Edmund, go ahead and unmute yourself and explain.
Yeah, Kevin, you talked about like Bitcoin, all these other assets, buildings. Can somebody have just one installment sales trust and have their building in it, have their business in it, and then have Bitcoin all kind of rammed into that same trust, or they have to have separate trusts?
No, I have a gentleman right now unloading a private bond portfolio. These aren't publicly traded bonds. He's unloading about half his Bitcoin portfolio because he wants to lock that in. And we're selling that on the exchange in Zurich through the RIA firm, my cousin's there. And then he's unloading a property in Canada into the trust. We even do these internationally. He's Canadian.
Yeah.
So yeah, it's one trust. Oh, I may not have mentioned this. We don't commingle. Every trust is a one-off. It has a unique name the client picks. It has a unique tax ID. Their money is never commingled with anybody else's. This isn't one big trust where everybody's jumping in.
Yeah.
Yeah. These are each one-offs. Yeah. We don't commingle anything.
Okay. Got it.
I'd just like to say a quick point. I've been an investment advisor here in Canada for 15 years plus, focusing mostly on private equity real estate and tax. And I just got to say that Kevin's speaking the truth, like the real stuff. He's the type of guy that I listen to. He's got the right attitude. Like for me, if I was to take another run at it, like I'm retired now, but if I was to take another run at it, there's a lot of key things that Kevin was talking about, a lot of gold nuggets. And what I see is, what I like about private equity is that you're looking after assets that are not on the market and you're not competing with everybody else. So what you can do is you can use a guy like Kevin to come in and say, I want to grab that property. Let's see how old that vendor is. And can we go and claim that with nobody else looking? So I'm not in competition with that. So how I would leverage that is another thing that he said, which is go in and try to educate all the accountants in your fold and get them to listen to what Kevin's doing. Then you get your accountants also to look for property for you. So he's speaking like all the right stuff. That's exactly along my page of like, I think it's.
Yeah.
Well, thank you.
Yeah. And
I learned what I do because I screwed up in the beginning a few times. So, you learn how to work with the CPAs, you learn how to work with the attorneys, you learn how to have them share clients with you. It wasn't that smooth when I first started doing this, I have to tell you.
And incidentally, Ed and I talked about the same thing, a month ago about how to work with the attorneys, how to work with the accountants, how to work with all of that. So yeah, I knew you guys would be on the same level there. Let's see, another question that got thrown in there, and Kevin, just before you go, make sure you share your contact information. That's probably absolutely vital to a lot of people. I think a lot of people here are going to be very interested in following up with you.
Easiest way to do that is go to kevinbrenner.com.
All right, I'm going to drop that into the
kevinbrenner.com. From there, you can click and see everything.
All right. All right. Any other questions? And I know he's got another commitment at the top of the hour. So we probably got, 1 or 2 minutes before he'll have to log off and hop onto the other call.
Hey, Brian, can I jump in real quick?
Yep, you just did.
So I already maybe went to one of your competitors. I'm not sure. I'm assuming it's one of your competitors. I already set up an operating company and a holding company, an estate plan, a trust, the whole package. They're going to move the stuff into these things so I can get anonymity. I can get, liability protection, all that thing, right? Mm-hmm. What if I don't want this anymore and I want to go to Kevin? How does that look like?
Some of that stuff might be a good idea, and they might have sold you a bunch of stuff you don't need yet. So I would have to look at it. There's a lot of firms out there that sell these packages, and they give you all these things. First off, in today's world, if you want to be anonymous, that's very difficult. If they know you have assets, they know how to harass you. So the kryptonite to lawyers is to make sure that even if they win, they can't get paid. The kryptonite to lawyers is even if they win, they can't get paid. Watch how quick they settle with you. They'll throw their own client under the bus. So you might have been sold a great package that you need. I don't know. But a lot of those firms will sell you these packages, and you'll set up all this stuff, and you have all these on-running expenses and complexities that aren't necessary yet. So you can go down that road and do the things you're talking about by begin with the end in mind, the old Stephen Covey saying. Yeah. So know how to do those things and start building, and then add those things as you need them. You'll save a lot of money. You might make a few tweaks along the way as well. So, but I don't know, you might have got a good package. I'd have to see it as well. Nice. But sometimes maintaining all those entities before you need them can become very expensive.
All right. And Kevin, last question from me. So let's say you're a syndicator exiting a syndication, do distributions from one side to the other. Is there anything you can do for a syndicator or a deal sponsor like that who's looking at a windfall themselves?
Yes, you transfer ownership of that into the trust. Mm-hmm. When it comes time to go back into another investment, you direct the trustee to fund an LLC as an investment from the trust. And
we can still pay all the investors what's due to them and keep our portion in the deferred trust.
This program was actually created so partners could leave and do separate things. And then Ernst & Young started offering it to clients, and they started offering it in M&A transactions. Versions of the Installment Sales Trust are used in most M&A transactions.
Okay.
And people don't even realize that's there. So if you have a group of people in a syndication, some might want to leave, some might want to do this, some might want to whatever. So they don't all have to do it. You can offer it all of them if they want, but others probably have other things they want to do, but that's fine. Each can do their own thing.
Right.
Because this is just your share that gets transferred into the trust.
Oh,
and then you can go back into another syndication on the other side by directing the trustee to fund a limited liability company as one of the investments.
Nice. All right. Perfect. Yeah. I remember you saying that, but I didn't connect the dots myself, but yeah. Thanks for connecting that dot for me. And that's something I know we have a handful of people who have definitely syndicated in this group, and people who want to syndicate properties. So, if on the
you'll have an apartment building you might want to buy into, and they'll say have maybe 3 partners, mm-hmm. and you can buy one of them's position and use us to do it.
That works too.
Yeah.
So if
'Cause-
one person in a partnership or a JV wants to sell their interest, we can do it through the trust. All
Yeah.
right, we're 3 minutes to the top of the hour, and I know you got to hop to Hutch's meetup. So I'm just
Thank you.
thank you very much. I appreciate your time, and
I
encourage
appreciate being-
anybody here to reach out to him if you have further questions. Kevinbrenner.com. I put the link in the chat notes, and there we go. Thanks.